This LOS is describe mechanisms that discipline financial reporting quality and the potential limitations of those mechanisms. Mechanisms that discipline financial reporting quality. Markets potentially discipline financial reporting quality. Companies and nations compete for capital, and the cost of capital is a function of perceived risk, including the risk that a company's financial statements will skew investors' expectations. Thus, in the absence of other conflicting economic incentives, a company seeking to minimize its long-term cost of capital should aim to provide high-quality financial reports. In addition to markets, other mechanisms that discipline financial reporting quality include market regulatory authorities, auditors, and private contracts. Market regulatory authorities. Market regulatory authorities play a central role in encouraging high-quality financial reporting. Here's a list of some of the requirements that help contribute to high-quality financial reporting. 1. Registration requirements. 2. Disclosure requirements. 3. Auditing requirements. 4. Management commentaries. 5. Responsibility statements. 6. Regulatory review of filings. And finally, 7. Enforcement mechanisms. With regards to auditors, audit opinions provide financial statement users with some assurance that the information complies with the relevant set of accounting standards and presents the company's information fairly. And finally, private contracting. Aspects of private contracts, such as loan agreements or investment contracts, can serve as mechanisms to discipline financial reporting quality. Detection of financial reporting quality issues. A manager that wants to increase performance and financial position in the current period could 1. Recognize revenue prematurely. 2. Use non-recurring transactions to increase profits. 3. Defer expenses to later periods. 4. Measure and report assets at higher values. And/or 5. Measure and report liabilities at lower values. A manager that wants to increase performance in financial period in a later period could 1. Defer current income to a later period, save income for a rainy day, and/or recognize future expenses in the current period, setting the table for improving future performance. A quick practice question. A company wishing to increase earnings in the current period may choose to A. Decrease the useful life of depreciable assets, B. Lower estimates of uncollectible accounts receivable, or C. Classify a purchase as an expense rather than a capital expenditure. Okay, nice question that makes you have to think a little bit. B is correct. If a company wants to increase reported earnings, the company's managers may reduce the allowance for uncollected amounts and uncollected accounts expense reported in that period. Decreasing the useful life of depreciable assets would increase depreciation expense and decrease earnings in the current period. Classifying a purchase as an expense rather than a capital expenditure would decrease earnings in the current period. The use of accrual accounting may result in estimates included in financial reports because all facts associated with events may not be known at the time of recognition. These estimates can be grounded in reality or can be managed by the company to present a desired financial picture. So continuing with detection of financial reporting quality issues, now we're looking at presentation choices. Because investors try to make intercompany comparisons on a consistent basis, earnings before interest, taxes, depreciation, and amortization has become an extremely popular performance measure. EBITDA is widely viewed as eliminating noisy reporting signals. That noise may be introduced by different accounting methods among companies for depreciation, amortization, and intangible assets, and restructuring charges. Companies may construct and report their own version of EBITDA, sometimes referring to it as adjusted EBITDA. By adding to the list of items to exclude from net income, items that analysts might encounter include the following. Rental payments for operating leases resulting in EBITDAR. I put the R there in just to catch your eye. That's earnings before interest, taxes, depreciation, amortization, and rentals. The R is for rentals. Equity-based compensation, usually justified on the grounds that it's a non-cash expense. Acquisition-related charges. Impairment charges for goodwill or other intangible assets. Impairment charges for long-lived assets. litigation costs, and loss gain on debt extinguishments. And that's the last slide for this LOS. Thank you.